Ladies and gentlemen, good day and welcome to the conference call organized by ASK Investment Managers on equity markets, the way forward. As a reminder, all participant lines will be in the listen-only mode. Should you need assistance during the conference call, please signal for an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Prateek Agrawal, Business Head and CIO at ASK Investment Managers. Thank you, and over to you, sir.
Good morning, everybody. Thank you for being on the call. I will divide my talk in a few sections. Talking first on the virus issue, then on the valuations, and then ultimately on the sectors which get impacted and how our portfolios are positioned. To make some small comment on the issue at hand, humans have been able to control many viruses like smallpox, have learned to live with many like measles, and have undergone lifestyle changes to control things like AIDS, etc. So while the current one is causing a lot of anxiety, we as a race have been very, very adaptable in the past. Corona, we have some good news that China has been able to contain it, South Korea has been able to control it. However, we do believe rest of the world, including India, should see cases going up for the time being. While the Chinese handling clearly inspires confidence. The overall damage, the small point being that while the near-term damage to the economy can be there, but long period damage to economy on account of viruses have usually been averted in the past. To give you a view, a permanent damage of let's say 33% that the market has seen implies that future earnings and growth for a very long period of time has also undergone a similar damage. When we put our thoughts to that, we believe this then creates a good opportunity. For the purpose of the call, let us assume that versus expectations of earnings growth in FY21 over 20, there would be a cut. With that assumption, let's move forward. We don't believe FY20 numbers get impacted because this is occurring at the end of the period, and for most companies, the numbers are in back. Coming down to valuations, Indian market has seen a sharp drop of 33% over a period of 2 months. But most of the drop has happened over the past 20 days. While valuations were expensive on PE terms before the fall, we were still able to justify them because bond yields had also fallen in the same period, and on a bond yield to an earning yield matrix, valuations were holding up. Now, after the fall, valuations on a PE basis on long period average are fine. Actually lower than long period average if we assume good growth in 21 over 20, if we assume significantly lower growth in 21 over 20, but growth nonetheless, we are still on the cheap territory. On earning yield to bond yield, this gets less impacted by growth projections. We are placed most favorably over any time over last 15 years. So that's the kind of levels in the market that we are seeing, and we should see it in the context of interest rates. I do believe basis that we are very, very attractively poised. What are we doing? We continue to focus on the high quality, high growth part of the market towards delivery of preservation of capital and growth of capital. This is the part of the market which has continued to deliver earnings growth as per expectations. While the components of growth may have changed, so beginning of the year one would have assumed a higher volume growth, and versus that volume growth may have been lower, but given higher margins, given lower commodity prices that we have seen, the overall growth has come in almost as per expectations in this part of the market. So interestingly here, whenever I had spoken to our partners, we had made this point that for us, expect price performance to be lower than earnings growth, because we did believe that valuations in our part are a tad higher than where they should be, and we expected valuation corrections to occur over a period of time. Now that has happened over a period of 12 months ending December. While on earnings front, our portfolios delivered 27% earnings growth, but the price performance was 12%. And even before this carnage started, our portfolios had undergone a valuation correction of close to 15% on this count, mainly on account of very good earnings growth, while portfolio performance kept pace with the market or was slightly better than the market. Post that, index at the same period, by the way, trailed earnings growth. So the index had done 12% versus a 9% growth in earnings. And after that, very clearly, as markets, digested the performance of various parts, our portfolios held up very well. To date, in the month of March, we may have fallen 24% versus Nifty of 27%. Calendar year till date, we have fallen 22 versus a Nifty of 33%, and over last 1 year, 15% versus index of 29%. Better earning delivery in our part has held up our part much better than the broad market, and we do believe that to continue going forward as well. So now that the valuations have corrected in both parts, index, I said, is now very nicely positioned on earnings yield to bond yield valuation, cheapest in 15 years, lower than average on PE valuation, even if we assume very small growth in 21 over 20. And for us, we had seen a sharp drop in valuation on account of earnings growth, and more because of the fall that we have seen in the month of March in particular. We believe now valuations are on our side. Going forward, while in the immediate term we may see undershooting, the expectation setting should be that earnings growth and price performance over a period of time could look very similar. Now let us look at sectoral perspectives. On an overall basis, we should expect global GDP growth to be significantly lower as big markets in the Western world stay quarantined for a period of time. Indian demand outlook should also be assumed to be slow. We are also quarantined. All of our cities are undergoing a quarantine. But, on the whole, because of a sharp fall in the price of crude, we may not see a large damage on our GDP. It could actually be same, or there's a chance it improves. While the global growth is low, Russia and Middle East, which could have cut production to sustain prices, have actually opted to increase production. And that's resulted in a sharp price fall in oil. And this is interesting now. Till they produce more, price of oil will stay low, and if they don't produce more, the price of oil goes back to where it was before, because then the shale oil provides a cap to the possible price in the marketplace. A dollar drop in crude is a 1.3 billion save for the country. As of now, crude prices are $30 lower than the beginning of the year. And that gives us potential savings of US dollar 40 billion for the year on a run rate basis. Now, yes, oil prices will increase if global economic outlook changes, but then both will happen simultaneously. So we will then get a benefit of a better global economy and maybe face a loss from oil and vice versa. Now, in terms of quantum, this amount is about 1.4% bump up to GDP. Okay, mainly achieved through reduction in net imports. So this is substantial. Now, trying to come to the portfolios, the portfolio construct, where are we positioned? Do we continue to do well? Basis earning sustaining in our part better than other part. Let me just try and build that. Once again, start with lower commodity prices, start with lower crude prices sustaining for some time. So that is one thought. Yes, in terms of spaces that get hurt are travel, tourism, discretionary spends, hotels, QSR, entertainment, etc. Media would suffer from lower ad spends. IT growth may get impacted because of lower travel and transitioning, both for sales and business transitioning. But in IT, immediate term numbers may not get impacted as visa costs and travel costs reduce. Okay, also, we have seen them already announcing, lower increases or no increases and lower bonuses. So, PAT numbers may not get impacted there. We are not invested in these parts at all. We are not invested in these parts at all. We have stayed away from these because, particularly IT, where quality has, but growth outlook has been much lower than our minimum. So we have stayed away from these parts, and in times like these, that helps us on a relative basis. Now, lower commodity prices imply that businesses with pricing power benefit from higher margins. If we look at our own behavior in the marketplace, people are stocking up on daily consumption items, most of it FMCG and food. So while there can be some preponement, some postponement of demand here, let's say on a quarter basis or 2 quarter basis, this is a part where in volume terms no demand impairment is foreseen. Yes, on account of concerns on increase in compensation, for the weaker sections, maybe daily wage earners, some impact happening. We can think of down trading, but volume terms overall, there should not be an impairment. Activities like painting, etc., household damage, repairment, etc. Well, luckily, this is not the peak season for that activity. It is usually post monsoons that this activity peaks. And for businesses like paints and adhesives, lower oil price benefit is large. That happens even in this quarter. So in this space, maybe there is some deferment of demand, but no permanent loss of demand. Amongst commodities, one commodity prices itself more on the demand supply situation where it is ticking. not on cost plus basis is cement. Okay, we have had some news of cement prices go up actually in South in an environment like this. But also keep in mind that this is a commodity which benefits tremendously from lower energy prices, both in the manufacturing process, and it is a very, very logistic heavy business. So even on that count. So these spaces are what would see the minimum damage to our mind, FMCG, stuff like paints, adhesives, and cement. And we have a large part of our portfolio in this part. So 30-35%, yes. Durables may see some postponement in demand. That is a very, very small part of the portfolio. Durables, by the way, have and continue to have very strong long period growth outlook, given the low penetration levels and sustained increase in per capita that we have seen in them. So, yes, once again, demand for jewelry, a small weightage in our portfolios may get deferred into the next quarter as people postpone celebrations to better times. But once again, that would be a deferment rather than a permanent loss of demand. Pharmaceuticals and related chemicals, difficult to make chemicals actually benefit strongly. Pharmaceuticals more so because of demand, higher demand in a situation like this. Month-on-month growth in pharmaceuticals, even in the month of Jan and Feb, domestically has been strong. I do believe March should be stronger. Chemicals which go into pharmaceuticals benefit as a consequence of that. But also in chemicals, there was this large theme of buyers trying to diversify away from China, and China itself not really encouraging the sector given the damage it does to the environment. The big theme there is we are 1/10 of Chinese capacity, and with a 2-2.5% growth in demand, even a small shift of global preferences can result in our businesses growing in a sustained manner at over 20% for quite a few years. We have a part of our portfolio invested here, and it's done quite well on a relative basis. Lastly, if I come down to financials, that's a large part of our portfolio, a significant part, as that of the index. We are with life and general insurance businesses. Okay, they should stand to benefit. Both of these spaces, the penetration levels are low. And the scenario that is presenting itself in terms of this coronavirus related diseases, the space would tend to benefit from increased awareness of the product. Yes, sales may be lower for some time as person-to-person contact is reduced, but for people who can buy insurance without going to doctors for mandatory testing, smaller ticket insurance, etc., I do believe we should expect stronger growth. So this is a part of the market not impacted. It is very, very low in penetration and can continue with the growth for a long period of time. We are exposed to retail financiers. Retail financiers like HDFC Bank, Kotak Bank, handle the situation very well in periods like the GFC. Other retail financiers in our portfolio in the NBFC space handled the demonetization kind of a period very well. They have been able to manage very well in periods of uncertainty when a section of the population may have got stressed versus the others. So they are time tested. They are seen to be some of the best in their field, and we do believe they should be able to handle a short period of impact on their borrowers, if any. All of the names that we are exposed to, we believe are prudent, risk averse, which is what we like. Banks for sure lend mostly to people who have the accounts with them and they have seen their credit behavior over a length of time. The NBFCs may have gone to the unbanked section and hence may have that's one source for higher margins and higher ROAs. But once again, if they are not exposed to the city-centric, if their city-centricity is low, they would be less impacted. So our guys are more exposed to second-level towns and even smaller towns, not to the 4 or 5 metros where we are having the kind of issues that we are all facing. So in terms of now, we do believe we will not see a stress in the quality in the near term. Yes, in the medium term, maybe there is some damage on the growth prospects. If this thing persists, then yes, there can be some damage on the quality as well. But then this is the part of the market which has seen a very sharp drop in valuations, and we are getting very good franchisees at valuations which were not there for several years. So to our mind, it presents a very good entry point. We have a very limited exposure, by the way, to high margin lenders, the microfinance kinds. Wherever it was, we have reduced it. So that was on how the portfolio is constructed. I did make a point that our earnings have sustained portfolio basis much better than the broad market, and we do believe that they will sustain much better versus the broad market going forward as well. The financials benefit also from lower interest rates. So yes, in the immediate term, there may have been some bump up in yields, but look at this, that SBI savings rate is down. The ability to lend at lower rates is higher. The demand for credit is less. Globally, interest rates are low. People are flooding the system with liquidity, and various parts of the globe, including Europe and US, have seen interest rate cuts, and in the US close to zero now. So lower interest rates should sustain for businesses which lend to people on fixed rate basis, and that is small ticket loans, second-hand vehicles, two-wheelers, cars, so maybe CVs, both new and second-hand, maybe personal loans. Microfinance is a spread business for NBFCs, but can be a fixed rate business for banks. And stuff like gold loans, etc. If the input cost reduces, we should hope to see some amount of margin increase. We were already seeing NIMs expansion in a few banks. See, what happens is every quarter the mix changes and a trend may not come out, but we are already seeing NIM increases in some of the banks for sure. So margin increase, just like FMCG, is also a story for retail financiers. Lastly, coming down to flows. Okay, we have seen unprecedented bout of FI selling in the month of March. To give you some sense, as of yesterday, we have seen a 48,000 crores worth of selling. This is net selling, which is more than what we have seen ever. Okay, at a substantially, and this is after what we saw in Jan and Feb of 18k crores. Happily for us, the domestic investor is coming into the market in a very, very structured manner. My sense is mutual funds, pension funds, life insurance companies put together get in around or between 12 and 15k on a monthly basis, which can be put into the equity markets. So the selling by fire in the month of January and February was matched by domestics, crore for crore. And in the month of March, 48k crore selling by FIs has been matched to the extent of 42k crores by domestics. Okay, and hence the damage to the market has been limited to 33% versus what we saw in the period of the GFC. Whereas for half of the selling, we saw a much larger cut. Summarizing, we believe that after a sharp drop in valuation front, even if we assumed a slightly longer term impact on the economy and hence on the businesses because of this issue, we believe on valuation fronts we are at very good levels, in fact attractive levels on some count given the lower interest rates. Okay, yes, markets can undershoot, but that will only increase the attractiveness of the market. Typically in the past when such valuations have presented themselves, markets have tended to sustain and recover reasonably well. Second, we do expect some impact on our portfolio holdings, especially if the issue continues for longer. But on the whole and versus the index and the broad market, we do believe our portfolio companies and hence portfolio as a whole would deliver earnings more in line with expectations set, let's say, some time back versus the other part. The whole point is that one should keep faith, one should look at the market, look at valuations, don't let fear overcome oneself, maybe stagger investments, but definitely do take benefit of the fall in the marketplace that has occurred. We did look at how our businesses came back over last 4 or 5 years. So, one thing that is there with us is our churn ratios are very low. Okay, so we have been holding several businesses for several years, and that is something that you guys would have noticed. Come to think of it, over the last few years, we have seen a crisis a year. Sometimes it is the uncertainty of, what kind of new government would come into place. Sometimes it is demon kind of an event, sometimes a GST-led disruption, sometimes a virus kind of a thing that has happened now, sometimes an NBFC issue that happened last year. Okay, so we have been grappling with an issue a year. We have seen businesses correct themselves in the marketplace. But once the issue has passed by, we have seen these same businesses come back very, very strongly and create a new all-time high. We do believe that given our focus on quality, and we do believe our portfolios are built with some of the best quality of companies, with some of the best quality managements. Our errors have been small in the past. We do believe, we will come back very well as this thing blows over going forward.